So I'm going to get underway with a little introduction. And I'm going to keep it brief because Dr. Wish has a lot of material here and he needs a chance to get on with it. So firstly, though, I'm delighted to have Dr. Wish as our speaker. I want to thank him very much for giving his time to participate. And I know he's going to address the kinds of questions I see popping up here about his rules and techniques for managing your portfolio. And I think it's going to be highly valuable. Before I give over the reins here to him, I do want to just pop up, if I'm successful here. I move my screen over. This is a little very brief information slide about our next meeting, which will be on Tuesday, April 26th. A speaker will be Paul Townsend, who has spoken to us before in Eastern Michigan. The future ain't what it used to be, and buyable gap ups. And he's going to be addressing his 3 keys to investing success, some historical examples of how that can help address present opportunities, and the importance of consistent sell discipline. So all important stuff, and hope that many of you will choose to join us on April 26th. Now I'm going to put that away, and okay, the sharing is now for the panelists. So David can put his material up.
Okay. Well, Richard, it's been a pleasure to meet you and to talk to you in preparation for this. And I've always loved presenting at AAII. Before the pandemic, David and I used to drive to Virginia about 30 minutes, 40 minutes away from where we are. And we would present in Virginia at that local AAII. And it's always been a great group. And I also appreciate meeting Cookie Courage, which I hope Cookie is here. But she basically asked me last June, if you can think, about 6 months ago, if I would do this. And since we don't have to travel, although I would love to be in the Midwest or where you are to visit, we said yes. And I thought, gee, it's great. The market's strong. It's hitting new highs. What a fine time to go and talk about setups and how we buy things. And that's normally what I focus on, but I'm going to do that, but not so much today, because today I think we got to talk about more on managing risk and to get out of the market. I mean, I'm out of the market now. I don't know what I would do if I hadn't gotten out. I don't know what I would do now, but I'll tell you why I got out and show you what I look at. And I'll show you what I would look at to get back in. But please don't ask me when the decline will end. No one knows that. I am called a trend follower. And you know what that term means. It means we find a trend, we jump on it, we ride it until the trend is over. And therefore, we get out not at the top, but after the top is formed. And we get in after the bottom is formed. And anyone who can tell you they can pick tops and bottoms in advance is either they've done it by chance once in a while, or they're lying, because no one knows what the market will do. As the great JP Morgan said when asked about the market, he said it will fluctuate. And boy, does it fluctuate. And, I've been watching the last year or so, watching a lot of young people making money and trading crypto. And you hear from people, I do, how they're making money. And I'm saying, oh boy, these young people don't know what it's like to get into a real bear market. And when I talk about a bear market, I don't call a short drop like we had in 2020. Most of my life, since I started doing this in the 60s, when they got a bear market, it lasted for about 10 months. And it was excruciating how bad the market got. And I've been doing this since the 60s. I lived through the 1974 decline. I remember I was in graduate school in St. Louis. I remember outside talking to someone about it, and we were all talking depression, because during the bottom, everyone is so scared. And I've gone through the 87 decline, which I happened to sidestep. Before I knew all this technicals, I'll just tell you a little thing that when I was a kid, they used to say, as General Motors goes, so goes the economy, so goes the country. And I was looking at General Motors and it looked like it formed the top, and I just happened to get out of the market back then. And anyway, I avoided that 87 drop. And but I'm different from most of the speakers you have. I am not a full-time trader. I don't even consider myself a trader. I am part-time. I'm more of a swing position type person. I may hold a position for weeks or a few months, not a whole long time, basically. And, you know, when I make a mistake and I have a loss, I cut it right away. I may be out the same day or in 2 or 3 days. And one of the things I want you to know is if you can create setups that make you think, if the setup works, it should move up right now. Then if it moves down, the setup didn't work for whatever reason, you can get out and you can go on and buy it again later, or you can buy something else. So I'm going to talk about setups like that. But I'm a part-time at this. I never wanted to spend my life just watching the monitor all day. I know there are day traders and people who want to do that, and that's fine. I can't do that. I have a full career as a research psychologist. For the last 30 years, I've been running a research center on drug abuse at the University of Maryland. And in fact, I'm actually at the point when I'm doing this, I'm launching a whole new program to track drug overdoses in emergency departments and hospitals all over the country. So I like both things and I'm passionate about both. So you might say, how could you mix this interest and passion in drug abuse and stock market? And you know, there's an easy answer because both of them are addictions when you think about it. So I have been fairly successful over the years. I was able to get out early in the 2000 decline, the 2008 decline, the 2020 decline, and then the 2022, the current decline. And my IRA, where I do my principal trading, has since the mid 90s is now, it recently hit all-time high. It's about 20 times what I started with. And I know a lot of people can do a lot better, but let me tell you, I don't sit through declines. I manage risk, and I'm not that exposed. And I don't like to have drawdowns. And especially at my age, nearing retirement, I don't want to, I can't see having, you know, my pensions and my funds drop 30, 40, 50%. I think, I don't know, I could not handle that psychologically. So I get out of the market when I think, and I pull everything out when I think things are looking bad. So I've developed a bunch of rules and setups, and I'm going to share them today. And, you know, the stock market isn't like a recipe. Oh, do this, this, and this, and everyone will make money. It doesn't work that way. I have my rules and things that I find works for me in my psychology and my risk level. And I would say that I would invite those who are listening today to look over, you know what I'm saying, try it out, test it out on stocks that you owned, and take what you want and try, and what you don't want, just ignore. The most difficult thing is for you to know that when I say chart, that's C-H-A-R-T with a Boston accent. I have not lived in Boston since the 70s, where I grew up there, but I guess I kept the accent. So I hope you'll understand my English. The tools that I use to teach people in my class, I want to just tell you what they are. One of them is the Word and TC 2000 program that I've been using for over 20 years. And it's not the only stock charting program that there is, but I know it. I know how to program it. My co-instructor, David, knows how to do it. So that's what I teach the students. And it's very nice that the Word and people make it available to my class, to all of my students, free for the semester. Similarly, IBD. Investors Business Daily, I can tell you I never made money until I got that newspaper in the 80s. And now the newspaper only comes out once a week in print, but I get that. And I use their investors.com site, and investors.com makes that available to my students free of charge for the semester. So my students come out of my class knowing how to run TC2000 almost as well as I do, know how to access Investors Business Daily. And then the other thing is the newer version and the stronger version is MarketSmith, and they also make it available free to my students, so my students learn how to use MarketSmith. I'm also going to show you an app that I have on my iPhone called Stocks Tracker. It's the English is a little off. I think it's a Japanese company that makes it, but I'll show you. I use that to follow my portfolio and to follow a watch list before the market opens and afterwards, and it's pretty neat. It's very inexpensive. The person running my slides there, you can see, and sitting in front of the American flag, is David McCandlish. He's my co-instructor. He literally was the librarian at my research center, and he caught the bug from me. He's an IT genius. He knows how to program databases. He works on our drug databases, and now he also works on the stock databases and co-teaches with me. I could not do the course without him. And as I said, we just finished a class of 147 freshmen, and it was quite an experience teaching people basically 12 weeks out of high school. We're the first course they get, and they come into this program and they take 14 weeks. And when they walk out, they know how to use all these tools and how to manage their risk in the stock market if they paid attention. I do not have a course for the public. You can't take my course unless you're enrolled in the special freshman program at the University of Maryland. However, we have been talking for a while to the university about offering our course online around the world, maybe at some point. We don't have that up yet, but if we do, it'll be advertised on my blog and my tweets. I did a presentation like this on TraderLion at their conference. One of my prize students is now a partner at TraderLion, Richard Moglen, and you can view my presentation at TraderLion if you go to that conference site, or you can go to the webinars, my webinars on my blog. If you go to the tab called Topics, and down at the bottom it says Webinars, and you can get several different webinars I've done. The one that really I liked from the beginning was in July 2012, I believe. We did it for Worden, and yeah, he's showing you now where it is. Thank you, David. He's, yep, right at the bottom there. And we have one that we did in 2012 in Houston, and it really is very extensive about the tools that I'm going to just talk about quickly tonight. Finally, I want to tell you, I'm different from most people you may hear. I'm not selling anything. Everything is free. We're giving it away. We're basically teaching people, especially the young people, that I wish someone had taught me at their age. Boy, would my investing life have been different if I had a course like that in my 20s. And as I think I told you, when we do get paid sometimes for teaching our courses, David and I, all the money goes directly to my research center. None of it comes to us. I know that a lot of the people at AAII are older, like I am old, and we're very different in how we want to protect our money from these young students. We've got a lot of people coming in here from my blog and from my tweets, and they probably want to just run with things differently than the older people will. I will try and say something of value to the whole group. So I think with that, David, we are ready to go to the slides. All right. First of all, I want to just say, David made the slide for me. This basically is Enron. And all I want to tell you is I am not a professional financial person. I'm not a broker, nothing like that. Everything I do is simply for educational purposes. We may talk about some stocks today for educational reasons. Do not go out and just buy them. Anything I do, even on my blog or tweets, it's designed to say, this is what I'm seeing. Now it's up to you to see if you see it and what you think you want to do. Next slide. So over the years, I've been recognized by IBD. They did something on, what is it? Real profit, real people, real success. This is an AAII presentation I did in 2019 locally in the Washington, D.C. Metro chapter. Next. If you really want to learn and read a lot more about my history and what I do, the great Les Masonson interviewed me and wrote a 10-page article in the magazine Technical Analysis of Stocks and Commodities. I can't give you this chapter, but if you can get a hold of the November 2019 issue, or if you're a member, if you get a subscription, you can get a digital archive, and you could find this this article. And of course, I said if you need, you could read that instead of using sleeping pills. It'll help you sleep at night. Next slide.
Careful, I think Les is here.
Well, is he? Next slide. Les's book is great, by the way. Next slide. This is the mantra for my course, and it takes 14 weeks to teach students what every word means. In an uptrending market, which we are not in now, buy visionary rocket stocks that are bouncing off of support, or that are oversold, or that are breaking through resistance on above average volume. Basically, by the time the students leave the course, they know how to operationalize each one of these words and how to recognize it. Next slide. So I just wanted to tell you how I ended up teaching this course. That's right, we skipped that, David. That's what I normally use. Okay. This was published in the Wall Street Journal in 2005. I entered a contest that they had for business professors and business school professors and students. And I said, well, I'm just gonna enter. It was a multi-week, I don't remember how long it says in here, a multi-week trading competition, virtual money, not real money. And you can see the yellow thing with my name there. I came in 5th in the country. So I took this and I went up to the honors program at the University of Maryland, and I said, I know I used to teach a course on drugs in American society, but I have this second passion with the stock market. And look, I came in 5th in the country with all these business professors. Can I teach a course on the stock market? And I did that. They said, write it up, and I did it. It was the highest rated course at the University Honors Program. On the item, I learned a lot. And it was basically 20, mainly seniors, the best and the brightest at the university, who spent 14 weeks with us in a seminar learning all of this. And the reason I taught it was I had watched in 2000, when I had gotten out of the market early on, I watched as my colleagues and friends saw their pensions and their savings disappear. And at the same time, the media were saying, don't worry, just buy, just keep it. No one but rings a bell at the bottom. You can't, don't worry about it. That I just wanted to teach people what I wish, as I say, what I wish someone had taught me. So we started teaching the honors course. Then we started teaching this freshman connection course, both at the one in fall and one in spring. And then honors redesigned themselves, and we don't teach the honors anymore, but we do teach the freshman connection every spring for about 150 students. Okay, David, next slide. All right, next. So go back. All right, so these are listed on my blog. These are the books that I recommend a lot of people to read. And they are the books I have read voraciously of this in the last 50 years. And most of these books are the books that made a difference to my ability to tackle the stock market. So the first book we give, if you pointed it to it, David, is Alan Ellman's book on the left, which is Stock Investing for Students. And Alan Ellman is well known. You can see he has a couple of other books down there, Cashing In on Covered Calls and Complete Encyclopedia for Covered Call Writing. He's extremely good at teaching you how to trade options, especially covered calls and cash secured puts. And he wrote this book And it's really a great introductory book for someone who's, high school or college, who, it's just getting introduced to the whole financial area. And it's not basically all on technicals, it's technicals and fundamentals. It's the whole broad brush. It teaches you the language. And so the students read a number of chapters there, and they do have he does have a very good chapter on technical analysis. Now, they're reading that, but the first really book that they get into, and they have to read this the first week of the course, is the one that David's pointing to, How I Made $2 Million in the Stock Market by Nicholas Davis. And I remember that I was, I'd opened up an account at Merrill Lynch. They gave me this book, How to Buy Stocks by Louis Engel, which basically say buy cheap stocks, buy stocks with low price earnings ratio. I mean, just stuff that doesn't make you money. And I was doing that. I was finding, gee, I bought a stock that had low PE. It didn't go anywhere. I mean, so I happened to fall into this book. I was always looking for new books, and I read this book, and it changed my entire life. And it's a great book to read if you know nothing about the stock market. Even if you know, it's okay. But if you know nothing, this is a phenomenal journey that the author, Nicholas Davis, did in the late 50s, where he was dancing around the world as part of a duo. And he was given, for a gig, he was given some Canadian mining shares, and he didn't know anything about them. And he continued dancing, and he came back and he looked at the price one day, and he found that the shares had doubled or tripled. He said, wow, this is the way to make money. So he went on a journey to try and invest, and he did everything that most people would do. First, he studied it, and he talked to a broker, and he got investment newsletters, and he did all sorts of fundamental analysis, and he basically almost lost all his money. And then he gradually learned how to invest, so that in an 18-month period in the late 50s, he made $2 million in the stock market. And he wrote this book, which was on the bestseller list. And it's really easy to read. It's fun to read. And let me tell you that one of the things that you learn is the value of setting stop loss orders. And when I meet someone who's in the stock market, one of the first things I say is, do you use stop loss orders? If they don't know what a stop loss order is, I'm really concerned, because that's how you protect yourself. One of the big ways you protect yourself in the market. Davis used them so that when he was wrong, he had very small losses. When he was right, he had big gains. And I want to just tell you that when he wrote this book, he became famous. They tried to basically sue him and investigate him, but he had all his records to show that he was telling the truth in terms of the way he made money. Anyway, the second book there, Wall Street, Las Vegas, he wrote after he had made this fortune. And in the early part of the book, he compares brokerage houses to casinos. So as a result of that, no one would take his ads for this book, but it's a really good book. And his first book basically made Barron's, the Financial Weekly, famous, because while he was traveling around the world, he would have his broker ship out to him Barron's. He would tear out all of the language, all of the verbiage, and he would just look at the prices. All right. Well, when Wall Street, Las Vegas was published, Barron's wouldn't even advertise his book, is what he said. So that is those two are phenomenal books. Everyone should read it. We also give them Stan Weinstein's book, Secrets for Profiting in a Bull and Bear Market. It was written in the 80s, and it's really a good book. And he introduces everyone to stage analysis, which is something that I use. Mark Minivini uses it. A lot of people use a stage analysis. I will show it quickly, but you can get it from the horse's mouth from Stan there. Another book, we don't assign it, but everyone who likes the market and wants to trade reads Edwin Lefebvre's book, The Reminiscences of a Stock Operator. You probably should read it. It's a wonderful, wonderful book. Now, after they've read these other books, the Davis and Weinstein, The Bible of the course is William O'Neill's How to Make Money in Stocks. And everyone should know about William O'Neill's. Point to the book, David. So right there, that's not the latest edition, but William O'Neill, I actually saw him presenting in Washington. He used to go around the country promoting his newspaper. But William O'Neill worked for a brokerage, I think it was E.F. Hutton, in the 80s. And he did something really smart. There was a fund that was beating all other mutual funds. And I'm forgetting on his name, David, but O'Neill went and looked at what this person did with these funds, all right, over time. And they published when they bought stocks in the mutual fund. And he basically figured out that the person was buying stocks at basically new highs. And William O'Neill taught himself how to pick good stocks. He basically started his own recommendations. Imagine this: the E.F. Hutton would say to to their clients, to their brokers, you should buy stock XYZ, and William O'Neill would look at it and say, no, you should sell it. So he left the brokerage at fairly early, and he made enough money, I think about $250,000, to buy a seat on the New York Stock Exchange. And he made a lot of money, and he should have been a researcher. He, in a sense, was a researcher. And he basically created a database that he used to sell to financial institutions to analyze stocks. And after a while, William O'Neill said, I like helping the financial institutions, but I want to help everyday people. So he started a newspaper that used the database, in a sense, that he had sold. He was selling to high worth groups. And this book, How to Make Money in Stocks, is basically a manual for using the newspaper. Nowadays, it's a manual for using their website too, at investors.com. William O'Neill also wrote, someone texted me, emailed me a blog, and they say, how do I learn how to sell stock short? And I said, well, go to William O'Neill's book, How to Make Money Selling Stock Short. Okay. Now, there's a couple other books I just want to mention, then I got to move on. If you don't, I urge you to read these books and read these people, but there are two books written by John Boyk that are lessons of the greatest stock traders and how legendary traders made millions. Point to them, David, if you will. They're listed there. Those two books are summaries of most of the people that I've just been talking about. And so John Boyk very, very well summarizes what these traders did. All right. So you can see lessons to the greatest stock traders. Can you point to them, David, or is your arrow? There it is, there, and legend. All right. And by the way, I'm going to show you later on how you can get to Boyk's tweet feed, because he oftentimes puts out tweets which are great quotations from these master traders, and they're really wonderful. I think that's what I want to do. Let's go on, David. All right. Oh, the final book, I didn't mention it there. Think and Trade Like a Champion. I took Mark Menevitti's workshop about 5 years ago with about 80 other people. It's now done online. It was wonderful to be in the same place with these people. Mark Menevitti, to me, is this new generation's Nicholas Davis. He has made millions in the stock market, and he teaches people in his workshops, and he has a service where people can also keep in touch with what he's doing. But his books are phenomenal. And he came to my course and he gave these books out free to my honors students. And I recommend him very highly. Next slide. He recently, in 1997, I'm not sure about this, he entered the United States Investing Championship and ran. I think he made, I don't remember, it was 100 and almost 200%, where he was in the division where you trade $1 million of real money. It's all checked by accountants. And basically you compete for a year. And so he decided, he did it once in the 90s, he was going to show he could still do it now. And in 2021, he entered, and you can see he won that $1 million division. His portfolio of real money increased 334.8%. You can see the second place person was 100.4 and the third place person was 11.4. By the way, I tell all of my students, if you're going to pick a coach, if you're going to read books, get them from people who have made money in the market. Steve Forbes once said on TV that his relative, I don't know if it was his grandfather or his father, said, you don't forget, these are the Forbes magazine people, said, it's much easier to sell advice than to make money in the market. Well, it is. You get loads of people who will sell or give you advice, but do they have a proven track record in the market? That's who you want to listen to. Next slide. All right, I just wanted to show you this. We did this with my students in the class. We basically started this little poll, and each week, once they started trading, don't forget, these are students who basically spent 7 weeks reading these books and listening to my lectures and how to use setups and how to use stops. And they got 100,000, they each got $100,000 margin accounts to run over a 7-week period. And we decided to just ask them each week, once they started, to rate how confident they were in their trading. And basically we correlated that with how the market, I think this is the QQQ, right, David?
Yeah, either that or the SPY.
So it was how the market, we correlated it against how the market was doing. And what we found was the correlation of these two sets, and I know this is just a small number of people and everything, was 0.92. So I think what it shows is when you're making money and the market's going up, you think you're confident. When all of a sudden it comes down and you're not making money, you question yourself. And I think all of us are that way. And for those of you who are getting hurt in the market right now, you're probably questioning your abilities in the market, whatever. And all I can say is you hang in there and you learn from your mistakes, and you can make money. You can do it. Next slide. All right. On November 21st, I posted this on my Twitter account. It was the 25th day of my QQQ short-term uptrend that I keep account of and post every day. And I said, I started this blog in 2006 to share with people what I was doing in the market, having escaped the 2000 market carnage and later that in 2008. I am concerned by what I see right now. See my blog, and then you can go and look at my blog about that. Next slide. So then on December 20th, I retweeted it and I put this on top. When I posted this on November 21st, I originally had the word scared and changed it to concern so as not to panic anybody. I was raising cash in my trading account, which I posted on the next day. So I saw things that scared me. And by the way, I tell all my readers, I'm a chicken. At this age, I'm a chicken. I would rather get out of the market and get back in afterwards than stay in a potentially downtrend. So next slide. So one of the things I was looking at is every night, I've never shown this in public, by the way. I show it, I don't even think we show it much to the class, David. Every night, I complete one line of this spreadsheet, and at the close of the market or during the weekend. And this shows you, I want you to look at the 2 yellow columns. What that shows is using TC 2000, looking at all US stocks, I just do a count of how many hit a 52-week high that day and how many hit a 52-week low. And I want you to look at the bottom. Look at November 1st, very bottom. On that day, there were 317 new highs and 23 new lows. Now just go slowly, bring your eyes up. You're seeing 300 to 500 new highs. You're seeing very few new lows, certainly under 100. And then on November 10th, you had 102 new lows, 179 new highs. And look at what happened as you keep going higher and higher. Suddenly, And this is rare when this happens. Look at November 17th. You finally have more new lows than new highs that day. And look at how many, 361 versus 154. And then look what happened in succeeding days. You started getting 300, 400 new lows at the same time that the indexes, in a sense, was still going up. So, that really worried me. And you can see what's happened since. Look at, I only did the early November. Look at, now you were getting 500 and 600 new lows and only, double digits in new highs. So look, if you're going to do an O'Neill approach, a Davis approach, who only bought at all-time highs, and what I'm doing, if there aren't many new highs occurring in the market, then it's a tough market to be in. You want to be in a market where there are a lot of new highs being hit day after day after day. So that really worried me. The other thing I wanted to show you is one of the components in my GMI is the successful new highs, 10-day high. If you look at this, the column right after the date, David, point to that, successful highs. See that column? Basically, what I look at every night is, of the stocks that hit a new high, 52-week high 10 days ago, what percent are higher now than 10 days ago? If new highs is working as a setup, stocks that hit new highs should be moving up. So, Nicholas Davis used to say, and when his setups started to fail, and O'Neill said this too, when your setups fail, either you're not doing the setups right, you have lousy setups, or the market isn't doing good. So I want to just show you, look back at November 1st, if you had been buying new highs, 60% of them were up 10 days later. And look, on the new lows, it was very few. But look what happened after, basically, look what started happening around November 16th to 15th. All of a sudden, by your new lows, stocks hitting new lows, we're lower, 10 days lower. And look at the numbers going up, 50, 60, 70, 80, 90. So basically, that's an indicator I look at, basically saying, look, the game of buying stocks at new highs isn't working. And in fact, for those of you who want to short, this is basically saying if you shorted these stocks over, 10 days lower, you had a profit. All right. Next slide.
Eric, there was a question about what the universe was for these. Is it your 4,000 stocks or?
Yeah, this is the TC 2000 US stocks. It's about 6,900 stocks now.
Okay.
All right. Now, when I went to Virginia, AAII, a couple of years ago, I drove there and I said, wow, all I got to do is put in Waze and it takes me there. And I remember back, for those of you who are young, you won't remember this maybe, but one of the worst things when I was younger is you were driving somewhere and you didn't know, you'd never gone there before. You had to get out maps. You had to draw on them. You had to write down, turn left here, turn right here, do this, do that, right? And then you got computers and you got MapQuest, and then all of a sudden you got GPS, and now you have Waze, or there are some other Google Maps or whatever. It makes it so easy. And what I thought about when I addressed the audience, I said, not using stock charts is like going to a new place without Waze or something like Waze. You gotta know where your stock is in terms of a trend, where it's been, how high is it versus a historic prices. You need to know that. So next slide. So I sometimes quote myself. This is the most important slide in the whole lecture. I show it to students the first day because I say, if you drop the course, I hope you don't drop the course, but if you drop the course and you know this, you can prevent getting in trouble, whether it's looking at the market or looking at stocks. And all this is Stan Weinstein's stage analysis. I told you it's in his book, Secrets of Profiting in a Bull or Bear Market. And basically what you see is here, point to it. First of all, you see basically the closing prices of a stock. That's the line. Now I want to go back. Yeah, go to that. You see this black line there? That's the price of the stock. All right. And basically, the other line there in the chart is the 30-week moving average of the closing prices. For now, say it's the closing prices each week. So basically, the way you get this line is each week, you basically say on Friday, you add up all of the closes, the last 30 weeks, the last 30 Fridays, you add it all up, you divide by 30, and that gives you the number, and then you plot it, and that's what this line is. And then when you add next week's close, right, you drop out the 31st week. So you always have just 30 weeks. It's the latest, the last 30 weeks. Now, I'm going to tell you something. I wrote about this in my blog, and I've never heard anyone talk about this, but I sort of thought about it, and I thought it's important to understand. The only way that the 30-week average can decline is if the current week's price, closing price, is lower than the price, the closing price 31 weeks ago, which you're throwing out of the pool. So think about it. If your 30-week average is declining, it's a bad thing. It's basically saying the current price is lower than it was 30 weeks ago. You want to be in a stock or a market like that? So what Weinstein said is most stocks or indexes have a basing period. That's a stage one. The thing is just going back and forth, and the moving average is sort of just flattening out. Then all of a sudden, the moving average the stock, our index, whatever, closes above the 30-week, and the 30-week curves up. Remember, if it curves up, it means that the current price is higher than the one 31 weeks ago. All right, that's a stage. So he calls that stage two. Do you see how you're climbing above the 30-week average? All right, that is a stage two. Then at some point, the stock runs out of gas. It goes back and forth, back and forth. The 30-week average flattens out, and then the stock starts closing below the 30-week average in what he calls a stage four. So you got stage one, stage two, stage three, stage four. Stage three doesn't have to last many, many weeks. All right. All right. Now, go to the next slide. This is what Stan Weinstein said, and you should all do this. Take the oath that you are never going to buy another stock in stage four, or hold on to any of your stocks once they move into stage four. I want to amend that to say, and this is how I got out of the market. I'm not telling you what to do. I'm telling you what I do. When the indexes close below that 30-week average and it starts to curve down, I'm getting out, first in my trading account and later with my university pension money. And by the way, someone asked, I am now almost all out of my university pension. Most of my colleagues don't know that you can transfer your money out of your mutual funds in your university pension into a money market. That's what I did. And by the way, when I did that in 2000, I'm going to show you, I transferred out of my money market at around 106. And several months later, that same mutual fund was selling in its 30s. Could you imagine how I would have been feeling if I saw 70% of my money disappearing? I will not allow that to happen. And you don't have to allow it to happen either. Next. So why is the market trend important? Next. Well, even Davis said, after looking at how his stocks went, he said, and he's focused on the Dow. So he said, I found that the relationship between the average and my individual stocks were confined within certain principles, but they could not be measured exactly. From then on, I made up my mind to keep watching the Dow Jones Industrial Average. That's the main average of his time in the 50s, but only in order to determine whether I was in a strong or weak market. This I did because I realized that a general market cycle influences almost every stock. The main cycles, like a bear or bull market, usually creep into the majority of them. Next slide. All right. He also said, because a number of you are probably saying, hey, I don't care if the market's going down. I'm gonna still look for the gem, for the sort of needle in a haystack. He said, of course, there are exceptions to the rules. There have been any number of stocks that have multiplied in price manyfold in a bear market, just as there are plenty of stocks that have hardly moved in a bull market. But my temperament is such that I prefer to be safe than sorry. Do you hear that? Safe than sorry. So I keep out of a bear market and leave such exceptional stocks to those who don't mind risking their money against the market trend. Why in the world do you want to push against the tide? Go with the tide. Next slide. All right, William O'Neill said it the same way. He has his can slim. The M at the bottom is the market indexes. All right, they should be in confirmed uptrend since 3 out of 4 stocks follow the market's overall trend. Next slide. He said, you can be right on every individual stock factor, but if you're wrong about the direction of the general market, 3 out of 4 of your stocks will plummet with the market averages, and you will certainly lose money big time, as many people did in 2000. Therefore, in your analytical toolkit, you absolutely must have a reliable method to determine what direction the market is headed. The key is to follow, interpret, and understand that the general market averages what they're doing every day. IBD does that and puts it out on their site every day. Next slide. All right. And I oftentimes quote myself to my students, and I just want to say, it has taken me over 40 years, it's now 50 years of trading to understand the folly of fighting the overall market trend. Whether I look at Livermore, the great Jesse Livermore, probably the greatest speculator ever, his line of least resistance, or O'Neill's M and Can Slim, or Nicholas Starbuss's writings, I find these gurus all saying that there is a time to be out of the market when it is declining or to be short. This is a very difficult rule to follow because even in weak markets, I am tempted to go long when I find the perfect textbook price pattern that brought huge profits in a prior rising market. The critical point to remember is that the same price pattern or setup that works so well in a rising market is likely to fail miserably in a declining market. You know, they oftentimes say the way to find out who's swimming naked is to look when the tide's going out. All right, you know, everyone looks like a genius when the market's going up. Next slide. So just want to show you quickly, this is annual changes in the S&P 500. The green, so many years the market closes up, but look at the horrible red lines that you can have, horrible markets. But if you look at the bottom, that's the S&P 500. If you ignored all these ups and downs and just owned the S&P 500 index, you would have been you'd be at all-time highs. So for those of you in my class, those of you who are young, who have many years, and you don't want to learn how to do this, it's too hard and you want to do other things, you can buy something like the S&P 500 index, buy it, hold it, and over the next 30, 40 years, you'll probably make money, okay? I can't do it. And most people who are closer to my age or retirement, I don't think they should be doing that. They're going to get killed potentially in a big down market. Next slide. So I just want to show you this real quickly. You go to a broker, and by the way, I tell my students, any one of you have a parent who's a broker, I don't want to offend you, but they're well named. Your broker will make you broker. What I tell them is they do this analysis that brokers will times show you, and they'll say, boy, if you look back over a certain period of time and you look at what happens if you had been in the market, what happens if you got out and you missed the 25 best days over this whole period, then you have this red, you see this red line? Look how lousy you would have done over time. But, right, and if you had been in on all days, you see that gray line? Look how much better you would. But you know what they don't show you? So they're basically saying, stay in the market because you don't want to be out of the market, just stay in there. Look at how much better you'll do. What they don't show you is the green line. And that's how well you would have done if you were out during the worst 25 days in the period, okay? I think it's a real false analysis because who in the world could just be out the best or the worst days? But I just want to alert you that a broker will tell you that, and you should basically be able to say to them, yeah, but you know what? If you're out the worst days, you do much better. So basically, they're going to tell you you can't time the market, And Mark Minervini likes to say, those of you who say you can't time the market are people who haven't been able to do it. Okay, it is possible to protect yourself. Next slide. So how do you assess the market trend? How do I do it? All right, I want to show you this real quickly. As you all know, in 1929, October was a horrible, horrible crash in the market. And how could Mark Twain in 1894 and Pudd'nhead Wilson write calendar? How could he write October? This is one of the peculiarly dangerous months to speculate in stocks in. How would he know that? That's the rest of the quote. So basically, the point is, and I tell the students, other than a market like we had last year or so, where the market's continually hitting new highs, it is really hard to make money consistently in the market. All right, next slide. So you got to learn what to do. So here's are the things I'm going to talk about. Let's see. All right, only an hour gone. All right, I'm going to talk about state analysis of the indexes. I'm going to teach you Guppy charts, which are named after Darrell Guppy. They're not about fish. I'm going to talk to you about GMI, which is my general market index, and T2108, which you can get on my blog. I'm going to talk a little about IBD market pulse and two contextual indicators, investor sentiment and put call ratio. Next slide. So, look, I just told you, if I could ask you, I would say this is the Dow Jones Industrial Average weekly, and that red line is the 30-week moving average. So if you were in my class, I would now ask you, having taught you stage analysis, what stage is the market in? And you'd also be saying stage 2. Basically Stan Weinstein say, be in stocks or be in the market when it's in a stage 2. So then what happened? In 1929, you finally got a close below the 30-week average. When you get a close below your major index, below the 30-week average, you should start looking for, when do I get out? How do I protect myself? You're not buying new stocks, all right? So in 29, the market had this huge fall from about 400 something to about 190, okay? This is the famous crash that everyone talks about. Now, what I want you to notice is, point out, David, the 30-week average started to curve down, all right? That is the other major warning sign you're looking for. When this 30-week average is curving down, it means, as I said, that the index is lower than it was 31 weeks ago, all right? Now, the market, then the Dow retook the 30-week average, all right? But it was still declining, and it didn't hold it, and then it came below it. So knowing what you know now, you would have known you should be out of this market where the Dow was below a declining 30-week average. Now you're going to say, Dr. Wish, it's too late. This is just too late. I wasn't out for the 29 decline because I didn't get out the first week it closes below, okay? What I want to tell you before you go to the next slide, David, is this is appropriate for how you analyze the market today. We are now below the 30-week average. It is very possible that we will have a rebound up to the 30-week average. And you're looking at that and you're seeing, does it hold it? Does the 30-week turn up or does it fall back below? Very important. So look, here it is. The market topped out at 400, fell to 100 and roughly 190, then rebounded, all right, then started down. So you think you missed the decline, right? Next slide. You see that little decline in 29? That was the 29 crash. What people don't talk about is what happened over the next 3 years. You were in. All right, everyone, I'm asking my class, what stage is this? You are in a stage 4 market decline. If you knew this, you would have been out of the market and you wouldn't be buying stocks and you wouldn't be trying to catch a falling knife. All right, you would be out. Okay, so the market bottomed all the way down around 40. So it went from 400 to 40. What's that, 90% drop? All right, so, all right, next slide. Then, all right, you got the depression. Then all of a sudden, The index comes above the 30-week, the 30-week average turns up, you're in stage 2, you buy, you can own, you can invest. Most people didn't have any money or they were scared. All right. Then it fell down again, became another stage 4. Then you had another stage 2. Then it went flat. And then look at the nice stage 2s you got in the 50s. All right. Now, here is something most people do not understand or think about. And it took me a while to figure this out. We all talk about Nicholas Starvis, and we all talk about how he made $2 million in the stock market, right? Look at that green line we drew at the top in 29. It took until 1954 for the Dow to retake its old peak. So everyone, ladies and gentlemen, those of you who think you can stay in the market because it always comes back, could you wait 25 years? I can. You this beautiful stage 2, when the market was hitting all-time highs, is when Nicholas Starvis made his fortune. So his techniques worked beautifully when it was a stage 2 uptrend. People who made fortunes in 21 were during a stage 2 uptrend. They looked like geniuses. Unfortunately, most of the young people have never been in a stage 4 decline. They don't know what it looks like. And they're holding on saying it's going to come back. So look what happened again. You can see in 60, it started to form a stage 4. Next slide. So I'm going to just show you a few more examples. Here's the 1986 and 1987 bull market. For the most part, a stage 2 uptrend. Then look at that. It closed below the 30-week average. Time to pull out. It's time to get defensive. Then it collapsed. All right. Then what happened? And everyone was saying, what's going to happen? Is it going to be like 29? Are we going to have a depression? Then it retook the 30-week average, right? Notice how it bounced up and down on it. And then it started up. And now you're in a stage 2 uptrend. Next slide. This is the 2000 top. Again, I can't overemphasize this. 99 and the beginning of 2000, you are in a stage 2 uptrend. Then the market closed below the 30-week. That's your danger sign. Then you wait, maybe you get out then, but then you watch. And now the 30-week starts curving down. So you see where I'm pointing with the arrow? That's when I got out of the market. I pulled all my university money, as I say, out at 103 at that point. And now you're going to say, Dr. Wish, you were late again. But look what happened. I pulled out way up there and the thing fell all the way to below 21. And by the way, I want to show you that it did notice, you've got to notice that it did retake the 30-week, but it didn't hold it and it didn't curve up. You're still in a stage 4 decline. And then in 03, no kidding, in 03, I got back in. You see where I got back in? And my account was up 50% that year. And why did I get back in? Because it was a stage 2 uptrend. Next slide. All right, here's your 2007, stage 2 uptrend, closes below the 30-week. All right, you had a quick drop below, came back up. All right, but the 30-week is still declining. It's still a stage 4 decline. All right, I got out somewhere around there. And then I said, oh my God, it went back above the 30-week. Maybe I was wrong, but I stayed out. So look, I got out around 44. What happened? Next slide. Here's where I got out and went all the way down there. Look, stage 4 decline. All right. Then it retook the 30-week, entered a stage 2. And I know it's not perfect. Look in 2010, it went up and around the 2000, it went around the 30-week. So The 30-week really wasn't declining there, but it did in 2011. So you have to decide how much you want to take off, but you want to be mainly in a stage 2 uptrend. All right, next slide. All right. David, I want to quickly, can you go to TC 2000? I want to show you a weekly chart, 30-week. The weekly. All right. Look at what we have. We've been in a stage 2 uptrend. All right. You see that green line? That's the SPY. Look at the Qs. Again. Look at the Qs. Look at the Dow. All right. You guys, again, I'm sorry. It's simple. You know what I teach the students? I say, if you're crossing the street and you look up the street, not too far from you, and you see a car or a truck bearing down on you at high speed, do you stand there and say, I know they're going to stop. I know the guy, he's going to stop. He's going to turn. You get the hell out of the way. You have to do with the market. The market is not right now in a true stage 2 uptrend. It's not in a stage 4 yet because it hasn't curved down, but that's why I get out. So right now, having seen all the examples I gave you, I'm giving you a real example, real live example. I don't usually do this, of why I would consider getting out of the market. And look at the Qs for a minute, David. I want to just show you, can you show the volume, drag the volume a little up. Each red bar there means, you see where I have an arrow? I wrote about in that blog. I started to see the market. Look at it at the top. Look at the heavy volume. That was a huge down volume week. And look at the next 3 big down volume weeks. All of that was signs, bad signs of distribution. Okay, David, let's go back to the slides. Guppy multiple moving average.
Dr.
Right?
Wish, there's an interesting question that somebody raised. Why 30 weeks? Why not the typical 40 weeks? Most people use 200-day.
All I can tell you is you can try it with the 40 weeks, see if it gives you the same signals. All I can tell you is Stan Weinstein, I showed you the picture, 30 weeks. I've been using 30 weeks.
Okay.
But you know what? Get your charting program and put up the 30-week and the 40-week and compare it. If the 40-week works better for you, use it. All right. Again, I say, don't believe anything I say, just try it out. All right. The other thing I want to show you. All right. David, leave it there. So Darryl Guppy, who's a technical analyst in Australia, he wrote a book. It's listed on my site. So, I don't think you need to read the book, but he came up with something called Guppy multiple moving averages. It's another way of getting a picture of what a stock or the market is doing. It's 2 groups of exponential moving averages. For those who are statistically inclined, a simple moving average just averages the prices. The exponential moving average gives more weight to the recent. Lots of times I give the same results, but the stage analysis I used was a simple moving average. Guppy charts are done with exponential. He has 2 sets of moving average. One of the shorter term periods, and they're 3, 5, 8, 10, 12, and 15. All right. And then there's longer term, 30, 35, 45, 40, 45, 50, and 60. Okay. So there are 12 moving average. Now I have adapted them, and you can go to his website. You can see guppytraders.com and read about this. Next slide. So what I do, I reversed what he does. My 6 short averages are red. My 6 long ones are blue. Okay. I add another average, which is it's a simple moving average of period 1. And that basically just shows the current price. If it's a daily chart, it would be the current day's price. If it's a weekly, it would be the current week. So you can see where the prices, where you're pointing, David. Notice how the prices are pulling all the averages up. Now, one of my honors students looked at this and decided to call it a red, white, blue pattern. You see the red, white, and blue pattern? It's drawn on a white background, and all of the red averages are higher, climbing higher than the blue averages. That is an RWB, a red, white, and blue pattern, and it's a strong pattern. It's very similar to stage analysis, and I like to look at this because when you see the white pattern disappear, it's between the two averages, that's a warning sign. So you can see at the 2000 top, you had the red averages converge with the blue, and the red started to go below the blue. That's a warning sign. Next slide. Here is the bottom. All right, the same thing. You're in notice that you're in a blue, what I call a blue, white, red decline. That means BWR, it means all of your red averages are declining below your blue with a white pattern behind them. Then all of a sudden, the price changes and the short averages pull up, they converge, it's no longer a BWR, and you wait for a red, white, and blue. That's when you want to be invested. Next slide. So this is the 2007 top. Notice the red, white, and blue until the top. And then you converge, your red, your blue start coming down, and then next slide. Well, this is the bottom. Yeah, then you see you had a blue, white, and red decline, and then you start getting red, white, and blue again. There you go. Next slide. So this is the current QQQ. Is this weekly, David?
Yes.
Let's go to the real slide. So look, if you want a longer term pattern, you can do this with weekly with the guppies. But I like to do the daily because it shows the patterns quicker. So this is daily. So you can see what the Qs have been doing. They had been in a red, white, and blue, it then converged. You are now in a blue, white, red decline. All right. Look at the SPY. Same thing. Look at the Dow. Same thing. You don't want to be in anything that's in a blue, white, red decline. I want to show you some examples. David, I want to show you how this helps you. Go to Peloton, which PTON. All right. Show it when it was climbing. All right. Here's what a stock looks like when it's climbing. It's red, white, and blue. And then look what happens. Your red, white, and blue disappears, and now your red is below. It's blue, white, and red. And now look what it's been doing. David, show Zillow, Z. Same thing. And again, you can use stage analysis. You can use this, whatever speaks to you. Let's look at Zoom, ZM. Look at that.
That's not Zoom.
ZM. All right. That's when you want to be in a stock. It's red, white, and blue. Look at Zoom climbing. And then look what happens. So I don't know. I want to show you Kathy Woods, ARKK. Same thing. She was in, a wonderful, wonderful stock picker, innovative stocks. But look at what's happened since the top. She's in a horrible blue, white, and red now. Do you want to buy it because it's a bargain? So let me see if there's anything else I want to show them. Yeah, they probably want to see Tesla. Show them Tesla. All right. Look at Tesla. Can blow it. Yeah, that's when it was up. Now look at it now. It is starting to form a potential blue, white, and red. It's not there yet. Okay. Okay. By the way, you can do this with mutual funds. David, type in contra fund, CONTRAFUND, and go to the one where it says the K class, I guess. Fidelity contra fund. You see it? or anyone. Look at it. It's a really great mutual fund, buys very innovative stocks. Own it when it's red, white, and blue. But look what's happening now. It's in a blue, white, red decline. When's it going to end? I don't know. When it becomes red, white, and blue. Next slide. Let's go back to slides. So you can apply everything we're talking to mutual funds. When you're going to buy a mutual fund, you want to run these charts, and you want to make sure you're in a red, white, and blue. Market Pulse. All right. IBD posts every day. It's on investors.com and on MarketSmith when they say the market's in a correction. By the way, in all of my history of reading the newspapers, the Wall Street Journal would never tell you to go to cash. In fact, I just posted recently that I'll never forget. I do forget the year. It may have been 1970. I was looking at the Wall Street Journal Herd on the Street column, which was right below the chart they used to have of the market, the Dow, and it said, you know, if there's anything we're sure of, it said, it's the market's going to go lower. And that was the exact bottom. So when everyone is saying the market's going to go lower, they're not looking for bottoms, and the media especially, and that oftentimes is near a bottom. And by the way, the only newspaper and system that would tell people to get out is Investors Business Daily, and now MarketSmith will do it. They won't have you staying in the middle of a correction. They'll tell you to get out or to raise your stops or whatever. Next slide. All right. Every weekend on Friday after the market closes, I post my general market index. Don't care about the GMI2. Those are just things that I track. Notice that as of last Friday, it was 0. Okay. Now, when that GMI is above 3 for 2 or more days, it's green. When it's below 3, meaning 0, 1, or 2, for 2 or more days, it turns red. David's going to show you a chart of how the QQQ does when the GMI is red or green. By the way, look at the 6 components. They're primarily looking at the Qs, sometimes the SPYs. You see that first component? That's the percentage of the stocks that hit a 10-day high, a high 10 days ago, a higher today. It was 21%. And the second one is the number of stocks that were new highs. It really should say now 6,900 stocks, and that was 11. So, and then I look at the daily Q, I look at the daily SPY, I look at the weekly Q, and I also look at the IBD Mutual Fund Index, which is posted on the investors.com site. It's basically an index of growth mutual funds. And what I realized is, if the growth mutual funds are not above their 50-day average and not doing well, I'm not going to do well buying their types of stocks. So that's what that measures. All right, next slide. All right, this shows you when the GMI was red or green and what the QQQ was doing during that period. So you can see during many of the really big declines, it was red. Next slide. This shows you look at the, I see 2020 drop. Look at how it was red most of the time. Okay. All right. You can see it's red now. It's not perfect and it's late getting back in, but it gets me out of the market quickly. Next slide. All right. You can find all of this on my daily blog. You see where it says 0, that's 0 out of 6. And the third black box there is the T2108 that I'm going to show you this now. Next. All right. The word in T2108, it is simply a measure of the percentage of New York Stock Exchange stocks that closed above their 40-day simple moving average. All right. They started it in 1987. All right. So all it is looking at is what percentage of the New York Stock Exchange stocks are currently trading, closing above their 40-day moving average. Next, David. What I noticed is, you see the green line there? It doesn't happen very often that this indicator gets below 10%. You can see in 87, it got about 0.5%, I believe. In 2008, it got 1.2%. In 2020, it got 1.4%. Okay. When you are in a declining market, a stage 4 market, you watch the T2108. And what I tell my students is, if the T2108 gets into single digits, you got to suck up your courage. Hopefully you've been out of the market, and buy a small amount of SPY, not individual stocks, because individual stocks don't necessarily come back. The SPY does. It always has. All right. And let me tell you, I tell this to students and I write about it in my blog, and I've never had the guts to do it. Maybe some of you young people will do it, because in order for T2108 to get so low, people are scared and are selling like crazy. And so if you look at the news and you look at what's happening, you're scared. But I try and promise myself that the next time it happens, David, you're going to remind me, right? The next time it happens, I follow the T2108 every day. It's always on my blog. It's listed. It hit 12, I think, last week, but it's got to get lower. So that is one thing that I look at to tell me that the market is potentially bottoming. It doesn't work on the other end. You see that red at the 90%? It's not, I don't use that. All right, next slide. All right, this just shows a different time period on a weekly chart. Again, as you can see, it doesn't stay below that green line in single digits very long. Next slide. All right, there are two other contextual indicators that I look at, and I get these from investors.com. One is the put call ratio. And whenever the put call ratio is basically a measure of options and how people are trading puts and calls. And all you got to understand on this is, if they're trading a lot more puts than calls, it means people are scared. Option traders are trying to protect themselves by buying puts. Okay. And that indicator doesn't get above 1 much. It did get above 1 a couple of days ago. So I posted that and said we could potentially get a bounce. Okay. But I don't know if you can pull it up, David, but if you ever get, it doesn't happen often, but if you ever get an instance when there were more, oh no, that's it for the put call ratio. I want to go to the sentiment. I'm sorry. Are you going to investors.com? Okay, you go to market trend, you go to psychological indicators down at the bottom. Okay. You go to put call ratio. Go to put call ratio. Where are you going? Oh, there. All right. That shows you when it gets above 1. I don't know how recent that is. That's today, right? It is now at 1.04. So it is in territory where you maybe don't get a bottom, but you get a bounce. You don't start selling here. When you get this on a night like this, it means oftentimes you're going to get a bounce. Good, David. Can we go to the bulls and bears? The other thing I want you to see is Investors Intelligence for years has been doing this survey where they get, I think it's 100 investment newsletters, and they categorize them as being bullish or bearish. And it doesn't happen very often. You see the bottom line, that's the percent bears. Whenever you get percent bears above the bulls, you see how they were above the red? That oftentimes is when you're getting a bottom. So look for that. Right now, there are not enough bears. You see there are more bulls than bears. The numbers are almost 40% bulls and 25% bears. See that? So that to me doesn't indicate that we're in a bottom yet in terms of sentiment. I use this to just give me more context on where the market is. Next slide, David. Thank you for getting them. Is that the next slide? All right. Okay. I teach this. I use this to teach the students this. This is Enron. Enron fell from 90 to 0. Okay. And I just want to show you real quickly. I think I took this from one of William O'Neill's books. This is what the expensive, smart investment people, the funds, the brokers. This is what they're telling you if you call them about Enron. Next slide. So if you can see, remember, it had been 90. All right. You can see when it was 62.75. You see that? Commerce Bank raised it to accumulate. So if you called them and it had fallen from 90 to 62.75, they would have told you accumulated. Merrill Lynch would have said, reiterated, it was a near-term buy. I'm not going to go through all this, but look at when it fell to 45.80. You see that? Goldman, the great Goldman Sachs, reiterated it on their recommend list. Okay, AG Edwards, which is oftentimes really good, they raised it to accumulate it. Okay, look at what happened when it was $33.10. AG Edwards downgraded it to buy, and Goldman reiterated it to the recommended list. I'm not going to show you all. Let me just show you that all the way at 36 cents, Credit Suisse cut it to a hold. Okay, Commerce Bank cut it to sell. UBS actually cut it to hold. They don't like to tell you to sell because they may be doing business with these brokers may be doing other business with these companies, and they don't want to offend you. But look, how can you ever believe a broker or any of these people after you see this? It's not any better. Next slide. All right, I'm just showing you, this is an old slide. I haven't updated, but very few mutual funds can beat just holding the S&P 500. Next slide. All right. I know a lot of you may watch Jim Cramer. I don't watch him usually. When I listen to CNBC, when I watch it, I watch the prices and I put it on mute. But I want you to just see what he said, because he's oftentimes going out every night, weeknight, and telling people what stocks to buy. He says many people get confused. They think we are trading the actual companies themselves, that the pieces of paper we are trading, investing, owning are some sort of redemptive right, a coupon that will give you certain cents off, or an ownership right that will allow you to have a chunk of the brick and mortar, if not the cash in the treasury of the joint. Untrue. These are, in the end, simply pieces of paper to be bought, sold, are manipulated up and down by those with more capital than others. The fundamentals of the company play only a part in what moves the stock up or down. I think the great Jesse Livermore said, we have the quote somewhere, David, I have to find it, basically says stock prices, this is in the 20s, stock prices are manipulated to the highest level and then sold to the public on the way down. Because what? The public wants to buy bargains. You do not want to buy bargains in stocks. Stocks are cheap for a reason. William O'Neill always says that. Next slide. All right. I just wanted to show you this. I'm not trying to pick on Cramer, but I happened to see him one day in 2016. In that morning, he talked up Fitbit. And if you bought it, you would have bought it where that arrow was pointing. And look what happened afterwards. No one knows where stocks are going to go. No one. Next slide. I love this quote I got from this book that Burton Crane wrote called The Sophisticated Investors. There's no magic about buy signals. They are only devices by which we call our attention to stocks that have already begun to attract the attention of others. You don't want to be a pioneer with a stock. You want to buy a stock, and this is what Davos did, that is hitting new highs, that the institutions are buying. You can track that in the volume, and they're moving up. All right, sometimes we show this animation that David does of a car race between an old Volkswagen and a Corvette. And I basically ask a student, I say, which one, if we do a race, which one's going to win? And they'll say the Corvette. And I say, play with me, tell me why. And they'll say it's aerodynamic, it's won other races, it's get more horsepower, a bigger engine. We run the race and the Volkswagen wins because the Corvette never gets off the starting point, the finish line. It's same with stock. You don't want a stock before it takes off. If you want it when it's showing a movement, when it's showing volume, when it's showing that the big guys are buying. Next slide. Those of you who are, my age, you'll know Will Rogers. He was a comedian. He said this: don't gamble. Take all your savings and buy some good stock and hold it till it goes up, then sell it. If it don't go up, don't buy it. I love that quote. Next slide. Davis, who, as I said, wrote he liked to buy stocks at highs, at new highs. Someone asked him, when you use a historical high as a buy point, do you hold literally to the historical high, or you can buy safely a stock making a new high for a lesser period, like 5 years, that also shows stepped up volume? His answer was, I strictly adhere to a historical high. I'm going to introduce you to, in a minute, to the green line charts, which basically is my way of buying, showing me that I'm buying a stock at an all-time high. If I were to ask you, the AAII audience, like I did in the past, when I would go there, I would say, raise your hand if you like to buy stocks at new highs. And maybe 5, 6, 7 people would raise their hand. And then I would say, how about stocks that are as high, they've never been as high before, historical high, all-time high. And maybe 1 or 2 would raise their hand. And then I would say to them, I only buy stocks trading at all-time highs. I'm not interested in a stock that was 100 and then fell to 50. Think about it. If you buy a stock at 100, and you will because you think, gee, it's high and it's good and it's strong and everyone's talking it up. Say you buy it 100 and it falls to 50. Like if you're like most people, you don't sell it at 95, 96, 97 because you know it's going to go up. You buy and hope. So you hold it, it falls, finally it falls to 75 or 80, and you say, that sucker, if that stock ever gets up to where I bought and I can get my money back, I'll sell then. So it falls to 50. You got all these people who bought higher up who are waiting to sell when it comes back. That's called overhead supply. You don't want to buy a stock that's down below where it was trading because you don't know if it can overcome all that selling. However, if you can buy it when it breaks through that all-time high, it has overcome all of that selling. That is the buy signal you're looking for. Don't buy stocks like you buy clothes or you buy food where you're looking for bargains. You don't want to buy bargains. Livermore used to say, I want to buy, sell, and sell higher. You know, some people think, oh, pun intended, I want to buy sheep and sell deer. No, you want to buy high and sell higher. Next slide. So everyone, this is what they want to do. They want to buy a stock like Apple. And look, if you bought it at split adjusted 13 cents, look how much you would have made. $1,000 turned into $922,000 over 36 years. But look at all the ups and downs you had to have. But I just want to show you, David showed them, look at when the stock broke to an all-time high. Look what happened. It went up. And then the next time, look at that when it happened. And then it stopped and then broke to another all-time high. Then it stopped and broke to another. Next slide. Microsoft, same thing. All right. And by the way, I'm going to show you in a minute. Notice how Microsoft formed the high at 99. That would form an all-time high. You don't get out. You get out. You don't wait for the next 10 years you wait until 2014, 15, when it broke to an all-time high again. That's when you get back in. Next slide. Microsoft, Square, same thing. You know, next slide. Tesla, same thing. Get it when it breaks to an all-time high. Next chart. All right. So these are my criteria for buying stocks. I'm going to go over some of them quickly. Of course, the market has to be in a stage 2 uptrend. The GMI has to be green or on a buy signal. Stock is above the last green line. That's what I was just talking about. Stock is in a stage 2 and an RWB uptrend. Stock is breaking out or is on support or oversold and turning up. There is an obvious technically based place for a stop that is close to the entry. No imminent earnings release scheduled. Most of your good traders or buyers will not hold through earnings unless they have a good profit, good margin. You know what happens when stocks report earnings. They can go up, but they can also collapse. I want to look at MarketSmith and make sure they have good fundamental ratings and rankings. I look on TC2000 for volume buzz. Volume buzz tells me if the stock, when I'm looking to buy it, is trading at a higher volume than average at that time of day. And I always try and buy stocks either on investors.com, IBD50, or in MarketSmith. They have this great computer-generated list of wonderful stocks called the Growth 250. I create a watch list of these stocks. My students did that, and you watch for the breakouts of these stocks. I do. Next slide. I'm sorry I'm going fast, but you can look at these slides later. I've given them to Richard. Green line. You look at a monthly stock chart. Okay, so each bar is a month. Look for an all-time high, a bar when the stock hit an all-time high, and it hasn't been surpassed for at least 3 months. That means 3 more bars. So basically, the idea is to look for a stock that has already advanced, has rested for at least 3 months, and then it breaks out again to an all-time high. Almost every approach that people use, if you look at Davis, if you look at Livermore, if you look at O'Neill, is buying stocks that have already advanced, rested, formed a base. With O'Neill, it may be a cup and handle base or a W, but they're all doing the same thing. They're looking for a stock that has gone up, proven itself, rested, and now breaks out from a base. Next slide. So here's an example. Where are the green line? Where would you draw green lines on this chart, David? All right, that's the first green line. Notice it tries to get above it, but doesn't hold it. Then look what happens. It forms another green line, top, and then it's off to the races. All right, next. Is that a green line top over there? No, because it hasn't rested for 3 months where it hasn't gone through it. Most of the students who build this, build it wrong because of that. Next slide. So I prefer trading stocks above their last green line top. They're either breaking through their green line or they're above it and are resting in another base. Slide. All right. So, all right. So here I was just, here's Cisco. Look at all the green line tops there where you could have bought Cisco on the way up. Then in 99, it formed a green line top. Get out of Cisco. Wait for it to go through that green line. Next slide. This shows you Microsoft. I was just talking to you about it. Look at the green line breakouts. Look at that finally formed the green line top in 2000. You're out until around 2014 or 15, it starts to go through it. Next slide. Here's Apple. Green line breakouts. Next slide. Gold. You can do the same thing with gold. Look at the green line breakouts. Gold is now below its last green line top. So I wouldn't really be interested in gold. Next. Here's Facebook. This is a really great example. Lots of times an IPO comes out, right? It forms a base. It goes up the first month. It then comes back and it goes sideways. Draw in your green line and wait for it to go through that green line. That's when you get interested. And then it formed another one. All right, next. Here's another one with, I can't see, yeah, Square, which is now Block, I think it's called. Another green line breakout. Next. All right, so I want to buy stocks that are near all-time highs, that are breaking through their green line, are above it and resting. I noticed this pattern. This is a weekly stock. Go ahead. This is Taser. This is a monthly period. Taser, at this period, went up to 21 and fell down to 3. Okay? This is before I had the green line top comment. All right? So this isn't drawn in green line. So look what happened. It fell down to 3. And then it came back up to 21 and broke through. That is a green line breakout. And most of you would have said, oh, gee, it's over. But you know what? It went up 7-fold again. One of the things that I've learned is with psychology with people, and it's true with stocks, and Davis used to say that, one of his criteria for buying a stock is that it already doubled. You want to find a stock that's going to double, find one that's already doubled. This one went up 7-fold. It went up 7-fold again. With people, you want to predict their future behavior, look at their past behavior. Next slide. So this is Taser showing on a weekly chart. Notice at the 30-week average, notice it's in a stage 2 uptrend during its rise. But notice also, you see that dotted line? That's the 10-week moving average. Some people consider it like the 50-day average, because the 10 weeks of trading would be 10 times 5 days. Each week would be 50. But 10-week average just is averaging 10 data points, the close of the last 10 weeks in a sense. Notice that the stock never closes below the 10-week. When I started this, I had yellow highlighters, and I would draw in this in yellow, and I would say, this is a yellow band pattern. So think about it. It's a stock in a stage 2 where the 10-week average is rising above the 30, and there's a yellow space. There's a space between them. All right. This is a beautiful pattern of an advancing stock. Next slide. This is Microsoft during a rise. Look at the yellow band. Next. This is Square. I wanted to show you this because I wanted to show you, see over on the left where it had the green line breakout? Look at the tremendous volume that day. So it broke out to an all-time high, and lots of times when a green line breakout occurs, which I call a GLB, it goes sideways. It may even retest the green line. My cardinal rule is, if I buy a green line breakout, I must sell if it closes back below the green line, because sometimes it will go below it but close the day above. All right, but lots of times you will buy a green line breakout, it'll go sideways and then take off. All right, next slide. Here's Zoom when it took off. Look at the yellow band pattern. So look, what I wanted to show you here too is, this is another way of knowing when a stock or even a mutual fund is perhaps topping out. When it's been following a yellow band pattern and then starts closing below the 10-week average. You see that? Point to it, David. It starts closing below the 10-week average, not there, further right there. And the 10-week starts to close down. Be careful. William O'Neill used like to follow the 10-week average as a place where a strong stock would find support. And when a stock fell below it on heavy volume, he was worried. And this is an example. When you've got a nice yellow band uptrend and your stock starts closing below the 10-week average, you may want to move your stop up, or you may want to take some profits. Next slide. Tesla, same thing, yellow band. Next slide. Peloton, yellow band. Generac, yellow band. So one of my other setups is, if you're in a yellow band and the stock bounces, that means on a week, kisses the 10 and then closes above it, I oftentimes will buy that and put my stop right below the weekly low. The other thing I want you to notice is a third moving average I have there is the 4-week. See the 4-week average? Point to it. On a rising stock, the 4-week average will be above the 10-week, which is above the 30-week. And oftentimes, if a stock has been climbing above the 4-week and bounces it, you see those green bars? Those are called a weekly green bar. And sometimes I will use that as a buy signal and put my stop below the green bar, low. Next slide. You can also use this on a downtrend. That's a yellow band down stock. Next slide. All right. I already showed you daily red, white, and blue, and I already showed you you can have a red, white, and blue uptrend and a downtrend. All right. I want to show you a few other setups. I like on a chart to have a Bollinger Band set to 15 periods and 2 standard deviations. That's what the 15.2. And I have 2 signals, which are a green dot and a black dot. David, we want to show them? So one of the things I want to show you, this is from investors.com. They show commodities, and you see the price momentum. I watched them and I noticed that a lot of rises start when this momentum was low. And for many years, I never looked at this. And so I talked to them what they were doing, and I'm not sure it was exactly this, but I started looking at a indicator called a stochastic. Next slide. And all a stochastic does is, for any period, it looks at, say I have a 10-day stochastic. It looks at the highest that the stock traded the past 10 days and the lowest it traded. And that's what this line, vertical line is, the high and the low. And then it looks at where is the stock currently at. If the stock is currently at the top of this range, it gets a value of 100. If it's at the bottom, it gets a value of 0. So I look at stochastics on my charts. Next slide. It basically tells me overbought and oversold. And what I want you to notice on this stock is show them the stochastics. That's the stochastic. There is a fast stochastic, which is red, and a blue one, which is slow. All right. Those are the stochastics. Note, when it gets down, when the stochastic gets down below that horizontal line, about 20, you see there, point to the other places. The stock is oversold, and it is a place where the stock oftentimes will bounce, including the Qs. So I put this stochastic, and the stochastic I use is the 10-4, that's my fast, and the 10-4-4 for the slow. All right. And basically, all I want to show you is that you can be looking at a stock. It has to be in an uptrend. It has to be above its last green line. If it's in a uptrend, then oftentimes I like to buy when it bounces off of oversold. So I would buy on one of these bounces and put my sell stop right below the low of the bounce. Okay. So as I say, one way is to buy when the stock is breaking out to a new high price. Another way is if you find a stock that's already broken out and then rests like this and bounces from oversold, that's another point to buy. Now, the other thing I want to show you is the Bollinger Bands. David, point to them. Go back. All right. On this chart are two Bollinger Bands, the lower one and the high one. And all you've got to know is statistically, almost 90% of your prices should be between those two bands, the higher band, the upper band, and the lower band. So notice how oftentimes at the time when the stock becomes oversold, it's also bouncing the lower Bollinger Band. So another setup to use is to have these Bollinger Bands on your stock chart and to know that you could buy, if it's a stock in an uptrend, you could buy it when it bounces a lower Bollinger Band. Okay, so notice there the green dot. The green dot on the chart, which I create on TC2000 and all my students create it, is basically when that red stochastic, the fast one, crosses above the blue. So point to that. You see that? That's when I have the green dots. So when I use TC2000, I can basically have these dots on my chart and I can scan for them and use that to search for stocks. Okay, David, let's go. There's a tutorial you can get that David wrote showing you how you can put this. If you have TC2000, you can build this on your chart. Next slide. I just want to show you this quickly. I have this stocks tracker, I told you, app on my iPhone, and I thought I was putting the 10-4 stochastic on it. And I was looking at it. Look at how beautiful the signals are for buys. Notice whenever it gets really low, the stochastic gets really low. It's a great place to buy. Next slide. Look at that again with these charts of different stocks. And I'm saying, wow, this is a great place to buy a stock that I want to buy that's in an uptrend, that's oversold. And then I looked at it and I saw I had made a mistake. It's not the 10-4 stochastic, it's the 10-1 stochastic. So it's basically looking at the prices, the price range over the last 10 days and showing in a sense where the price is in that range. So whenever it's really low, it's meaning it's near the bottom of the range. And it's turned out to be a phenomenal buy signal. So I built black dots on my chart. Then next slide. And look at this is another chart. This is Crocs. Notice how many times this stock is bouncing from oversold when you could have bought it right before it moved up. And notice it's also happening a lot when the lower Bollinger Band bounced too. So you can use, when you see many of these confirming, it's worked. This is GME. So when GME had that huge meme stock, had that huge rise, it went sideways. Look at the times you could have bought it when it became oversold if you wanted to buy it. Next slide. So that's my black dot indicator, which basically tells me when it's been oversold on that 10-1 stochastic and the stock is moving up. Next slide. That's a stochastic bounce. You see how it worked here with these stocks? By the way, none of these indicators work on a down market or a declining stock. You have to do it on a stock that's in an uptrend like this one was. Next slide. All right. You also, I don't want you to think I just buy stocks based on the charts. I'm always looking at the wonderful EPS and relative strength ratings, all of these, the fund ownership, the float, the short interest, all of these things I get on MarketSmith. Next slide. All right. William O'Neill wrote this, and it's very important. Buying a stock without knowing when or why you should sell it is like buying a car with no brakes, or being in a boat with no life preservers, or taking flying lessons that teach you how to take off but not how to land. Mark Minervini has this thing that he tweets out where he says, if you don't use stops, the market will stop you. You have to know when you buy a stock, if I'm wrong. And by the way, even Mark Minervini is wrong 50% or more times. You know you're going to be wrong 50% or more times, and you plan for it. You know how to define when you're wrong, and you put a stop in, and you never move your stop down. You put a stop in, and now you know that if you're wrong, if your setup didn't work, you're out with a small loss. Next slide. Okay. Even Stan Weinstein said on this podcast, how you deal with losing positions will determine how big a winner you're going to be in the stock market. Next slide. Expect the turtles. You could read The Complete Turtle Trader. I can't go over that, but you want to expect, when you buy a stock, expect the trade to lose and not fail. At the beginning of each and every trade, expect that it will fail. Know what you will do when it does fail in order to minimize the loss. Next slide. If you don't, look what happens. This just shows you if you have a loss of such certain size, how big a gain you need. If you lose 50%, you need 100% gain to get back to even. But if you only lose 10%, you only need 11% rise. You need to keep your losses small. Next slide. All right. There are a whole lot of ways you can manage your risk. I'm not going to go next slide. I just want to show you, you can look at this on the slides. When you have a setup, all right, you know why you bought it, okay? Then you must know when it failed and set your stop according to that setup. Next slide. All right, next slide. All right. All right. This is from Nicholas Davis, and all my students do this when they get done with their trading exercise. You have, all the great gurus do this. You have to analyze every loss. Livermore, it's rumored, would go into a bank vault on New Year's Eve and go over every one of his trades the past year. You go over your trades, you know where you bought it, you know where you sold it, you look at the chart and you write down what you did wrong. I literally did this with a bunch of stocks that I had traded, and I learned something I was doing systematically wrong over and over again, and I just reversed it and I started making money. Next slide, David. All right. This is for those who are young and starting out. Learning how to trade successfully is a long and difficult process. With zero commissions, there is a new way to learn how to trade. Buy only one share at a time. If you can't do well buying one share, you won't do well buying 100 or more shares at a time. Do this. Don't lose a lot of money. If you can't do it with one share, you're not going to do it with more. Next slide. All right. These are just ETFs you can trade because you can now buy the market to go long or to go short. These are a bunch of ETFs. Notice that there is one for the QQQ. There is a TQQ over there, which is a triple leveraged ETF based on the QQQ. In other words, it will rise or fall. It will rise twice as fast as the QQQ goes up or down. The SQQQ goes down when the QQ goes up, when the QQQ falls. It's an inverse ETF. So if you think that the QQQ is going to rise, it's in a stage 2 or whatever, you may want to buy some of TQQQ, and I'm going to show you something about that in a minute. If you think it's in a stage 4, you may want to buy some SQQQ. If you just want to buy the market, you can buy the SPY or one of the triple leveraged ETFs. Next slide. So I'm not going to demonstrate this now with QQQ, but I just want to tell you, I do this in my blog often. There was a red, white, and blue weekly QQQ uptrend from May 1st to June 11th. From May 1st, 2020 to June 11th, 21. The QQQ advanced 60%. If you had bought all right, so it went up 60%. If you had instead bought TQQQ, it rose 244% in that same time period. All right, only 3 of the NASDAQ 100 stocks beat TQQQ. Only 5 of the stocks in the SP 500 beat TQQQ. Only 18% of the stocks in the MarketSmith 250 beat TQQQ. The bottom line is, if you are good at knowing when the market, the QQQ, is in a rise versus falling, or in a rise, say, you can beat 90% or more of the individual stocks. How many of us are as good to pick out the individual stocks that are going to do so well? So you can just buy TQQQ. So what I do is when I'll post on my blog that the QQQ entered a short-term uptrend or downtrend, I will sometimes start buying TQQQ in an uptrend or SQQQ in a downtrend. So next slide. All right, I want to go through this now. Well, maybe I'll come back. Go back to TC2000, David. If you go to TC2000 and you look at SQQQ on a daily, okay, I wrote on my blog, you see the day, David, point to the second day above the 30-day average. No, right there. All right, on that day, I said the QQQ was in a short-term uptrend, and the TQQQ traded at, on that day, closed at what? 32 something. If you had bought on that signal and held it to now, you would have a gain of how much, David? It shows you. The gain would have been 30 what? 31%.
Yeah.
And I don't think, all right, that's 31% gain on the QQQ, the TQQQ in that period. David, can you quickly go to the NASDAQ 100? What? On the TQQQ, go to NASDAQ 100.
Up here.
Yeah. All right, I'm gonna just show you this real quick. Go to the NASDAQ 100 and now do a custom date sort. Go to Tools, Custom Date Sort. Okay, and do it from, I think the day is the January 11th. Yeah, right there. From there to that. Okay, you can, well, it says that now the TQQQ is actually up 34.8% from that day. Okay, now do a sort on it. Right there. Yep. Yep. I'm going to show you how many, now it just is sorted all the NASDAQ 100 by that time period. How many stocks in the NASDAQ 100 beat the 31%, David? 0. Okay? None did. So if you had bought TQQQ, SQQQ, I'm sorry, I'm getting confused. SQQQ on the day that I said it was the beginning of a QQQ short-term downtrend, right? You could have been up 34, you could have been up, you could have been up 34%, and you would have beat every stock in the NASDAQ 100. Because now, you know, all of them, if you look at how many of them went down then, by the way, David. If you look at the sort there, how many of them went up at all? No, go higher. You're in negative territory. Where is it? I
Well,
can't
that's
see.
0.
All
What are
right.
you asking?
How many went up higher? How many went up at all?
15.
So since I said that the QQQ was in a short-term downtrend, only 15 stocks went up, or 85% of the stocks fell. That is a perfect example that stocks follow the trend of the index. All right, let's go up. I want to wrap up, David. Go back to slides. Thank you. So these are websites that you can go to, investors.com, Finviz, freestockcharts.com is a free version of TC2000. Worden site is their next site. All right. One of my students, as I say, took my course, was going to be an engineer, became passionate about stocks, started doing YouTube videos, is now a partner at Trader Lion. Go to his YouTube channel. He took and he did a lot of YouTubes on my class, on things I taught in the class. And he and I worked together. He's phenomenal. Next slide. All right. Many of you may not go on Twitter. All I can tell you, these are some of the people that I follow. They are amazing people. They at TML. You can go to Richard Moglen. At TML Trader follows Can Slim. He picks beautiful stocks. Carter Worth is the person on CNBC who does technical analysis. Liz Ann Saunders works at Schwab. She tweets out the most amazing business charts, economic charts. I watch her every day. Now, if you like John Boyk, those books, and you want to know what some of the great books, what the great gurus have said, he is Monster Stocks 1, and he tweets out quotes. David Ryan was William O'Neill's protege. He's brilliant. He does not tweet much, but when he's saying he likes the market or doesn't like market, I listen. At Mark Minervini puts out a lot of information, and mine is at Wishing Wealth. Next slide. All right, this is an example of a Mark Minervini tweet. 6 trading rules. Wait in cash for proper setups. How long? As long as it takes. So he will sit out. Livermore would sit out. Livermore said, it's my sitting, not my trading, that made me money. Always trade with a stop loss. Keep all losses small. Never get bold when running cold. If you start having many losses in a row, pull out. Nail down your decent profits. O'Neill used to say, take profits at 20%. Minervini takes them at 10%. Never let a good size gain turn into a loss, and never add to losers. Never say, I bought some at 50. It's a bargain now. I'll average down and buy some more at 45. No, you were wrong at 50. Don't buy more at 45. You should be out. Next slide. Oh, I'm going to end with this because I think there may be a lot of AAII people who are near retirement. This article in AA and AARP really spoke to me, and I hope you'll find it worthwhile. And it's called Protect Your Money, and it was recently on, keep going. All right, Kramer, to comply with ethical restrictions, hasn't used his own wealth to buy individual stocks for years. Instead, he trades on behalf of a charitable trust. All his personal stock investments are in index funds on autopilot, with no stock picker at the helm, filled with shares of companies representing a broad slice of the market. So even though he's on TV every day talking about buying individual stocks in his charitable trust, in his personal money, he's buying index funds. But wait what he does. Next slide. Perhaps more surprising, Kramer cashed out half of his own investments in 2020. And despite his show's focus, he thinks that for many people, trying to invest in stocks that will beat the market is a terrible idea. He explains himself to AARP senior editor George Manns, who worked at street.com. All right, what do you mean you used to like? That's what I did. But when I turned 65, I cut that in half. Before, I had almost no money in cash. So now I have 40% in US stock index funds, 5% in international, and 5% split between gold and cryptocurrency. The other half of my cash is in cash. So he is in 50% cash. Now let me do, this is the clincher. Next, why the change? I had this long discussion with my wife, Lisa, when I turned 65, and she said, you know what? You've always said that you've got to cut back on stocks as you get older, but you refused to. And I said, well, I really feel I should have as much exposure to the stock market as possible. And she said, but we got to be wealthy. What is your point? We can only get unwealthy. That's all that can happen to us. Next slide. So how did you feel after that? It was so hard. I remember when I did it. Then the market went up the next 2 days. And I said, you see? And she goes, Jim, what I'm really talking about is that I have peace of mind. And I thank you so much for letting me have peace of mind. And now we don't have to talk about money. And we haven't talked about it since. Next slide. So I believe everyone, so he said, and stocks aren't what they seem. People should recognize that stocks no longer really reflect a lot of what's going on at a company. They really reflect what's going on in the stock market. These stocks pretty much all trade together now, and that's something that you didn't see, that didn't used to be the case. I believe everybody has to sit down with their partner, and both people have to be comfortable. And I urge everyone in this group to take that advice. I think it's really sage advice, especially if you have under 10 years left before you're going to need to take required minimum distributions. You're going to be required to use this money. Please do that. David, go to the next slide for a minute. You can follow me on the wishingwealthblog.com or at wishingwealth on my tweets. You can also email me at this. If you got a second, I want to do one other thing. Pull up TC 2000. I wanted to show you this. One of the things that we do is you can build into TC 2000. All my columns basically are different filters. There you can see showing me stocks that meet different criteria. I wanted to show you one thing. David, for one thing, go to DEC 2021 for a watch list. I promise, Richard, I'm almost done. DEC 2021. All right, that's one of my watch lists. And I wanted to show you, let me see if it's here. I was looking for, oh, it's not there, but I wanted to show you GLD. GLD had some very nice red, white, and blue patterns. So go back to the red, white, and blue patterns for a moment. And I wanted to show you that go to daily. Gold, this is gold, which had been on a red, white, and blue pattern. This is weekly. You can see weekly it's forming, and this is daily. Daily, you can see now, it is now in a red, white, and blue pattern. Notice down at the bottom, the high volume bars, the volume, there's big buying going on. And I wanted to show you something else I do. When I'm thinking of buying something, I now check this same chart on an hourly, because hourly will turn quickly than the daily or the weekly. So you can see gold, GLD, is now in a red, white, and blue uptrend, at least on the hourly. You can see the big volume buys. Now go to daily. All right, you see it is on a daily too. So lots of times when we're having a bear market, and I'm not saying yet that this is a bear market, people get scared of everything. They were going into crypto, but now they may be going into gold. So if we have a stage 4 decline, and remember, we are at the beginning possibly of a stage 4. If we turn into a real stage 4, then we really haven't seen anything yet in terms of a decline. Remember what happens in 2000 and 2007. The other thing I want to show you is I have a set of criteria so I can filter all stocks. So David, go to my flagged watch list. My flagged watch list is all stocks that I flagged because they are in IBD or MarketSmith watch list at some time. So they're stocks that meet the IBD investors.com and MarketSmith criteria. So they're good fundamentally and technically. So I watch them when I look for breakouts. This is what I look. So now, David, I want you to go to my easy scan. You see where there's I can barely see it. It should be right there. Click on that. something's wrong. Are you on, you're on all? No. They're not, you're not
Scan do you
using,
want?
what?
Which scan do you want?
The easy scan. Up top. You see, no, do you see, usually you can put, there's a place where you can check it. There's a check mark there.
Yeah, I know.
Can you blow
But
it
we need to
higher?
choose a scan.
It should have been saved. I haven't taken it out. It's already there. Unless it's not saved.
No,
No,
it
it's
would
not
have been,
saved.
it would have been, I just need to know what the scan.
I
is.
don't know the name, David. It's not saved. I thought it would be. So let me just tell you what I would show you. I have a scan that looks for stocks that are in, the 4 is above the 10 is above the 30. They're a strong upswing, and the 4-week is bouncing off of the stock is
Weekly green bar.
what?
Weekly green bar.
Well, it's not that one, but you could try it. What happens when you do it? all right.
Back to
And guys, I think it's about time to wrap
All
up.
right, all right. Notice nothing comes up. So what I'm saying is this great stock, looking for great, strong stocks, whether I look at just flag stocks or I look at all US stocks, nothing comes up. Because there aren't any good, technically good stocks in the market. Maybe there's 2 or 3 things, that's about it. You know, so with that, I think, all right, David, I think we're done. Pull up the last slide. I'm sorry that didn't work. But anyway, thank you for listening. I know we still have over 400 people listening. I appreciate, I hope many of you were able to stay awake. I really enjoyed talking with you, and I'm glad we were able to get through as many things as we did. We got through all our slides. Richard's going to have a copy of the slides. I think he may make them available, and there'll be a recording made available to all people. I will put it out on my tweet and on my blog, and I think Richard, AAII, will probably make it available too.
Yes, they will. Okay, yeah, we peaked at about 500 people. So kind of about what we expected. Thank you very much indeed. I greatly enjoyed that.
Oh, good.
Hope everybody else did too.
Thank you.
And I'd ask for a round of applause, but they're all on mute.
Well, I'm getting a lot of thank you and wows, and I just hope that people can take what I did and educate themselves about the market, how to read the market, and how to use setups, and take it easy, because you're going to have a lot of losses. That's okay. You're gonna, as long as you learn from your losses.
All right. Very good.
Thank you,
Okay.
everyone.
Thank you. And thank you, David, for your hard work there. And good night to everybody.
Good night.
Good night.
Good night, David.
See you, Eric.